There's more and more people worried that there's going to be a potentially large recession in 2023. And so that's what I'm going to dive into in this video. And I'm going to give you my game plan on how I'm going to invest in 2023. And so as you guys smash that like button, let me run that intro. What's up, guys, and welcome back to the channel. I think this is a large piece on everyone's mind, especially considering that most people are down right now. Some people are down more than others if they were heavily invested into tech in 2021, and as of course the 2022 downturn happened, the tech industry was down more than just the general S&P 500. However, the question is, what's going to happen, or what do we expect to happen in 2023? And so this is what I want to get into, and I want you guys to let me know in the comments below what you think about this question. Will the stock market's bearish trend continue into 2023? I'm very interested in what you guys think, and so I'm going to sort of talk about what I'm seeing. And the first thing that, of course, is on everyone's mind is what's happening with the interest rate increases. And so you can see that we are currently going through the most aggressive rate hikes in history. And so the first question that I have for you guys is, should we really expect a soft landing? And it's getting harder and harder for me to suggest that we will hit a soft landing. I don't really know. And so the market, of course, is starting to predict a recession. And I guess the only area where we disagree on most people is how bad will the recession be. And so you can see here, this is the uptrend in 2022. So you can see that it's been the narrowest increase the fastest increase ever. And so you can see what previous rate increases have done. And I just sort of picked out the ones that would have somewhat been in our lifetime. So if you're an older millennial like myself, you will probably, you might have been a little bit young, but you've definitely been alive during, the real estate collapse that happened in the early 90s. It was very bad in Canada, worse in Canada than I think it was in the US. But in the US, they also had their savings and loans crisis at around this time. It might have been a couple of years after this. You guys let me know in the comments when exactly the savings and loans issue happened. For any of you guys who haven't read a Peter Lynch book or any of the books written by Peter Lynch, one, that's a great place to start learning about investing. But two, it sort of puts you in the mind of a super investor navigating through that savings and loans crisis and what you can learn from that. But just going back to here, you can see that the rates seriously increased during the housing collapse. They also increased significantly, which, was one of the reasons that led to the dot-com bubble burst. But of course, the other reason was just the fact that the valuations were so high because a lot of people believed in the story, but didn't necessarily focus on valuation, which, I mean, if, history is ever going to rhyme, it did rhyme in 2021, where a lot of people believed in the hype for many of these technology names, but they didn't necessarily pay attention to the valuations, and they got burned in 2022 as a result of it. And then, of course, you guys may remember this one, the 2015 to 2018 race. All the Fed really was trying to do here was the market was hot, or the economy was hot, and they're trying to raise rates a little bit just to give themselves something. If the economy turned, they could reduce the rates a little bit. So they just needed some ammunition there. But of course, it caused a taper tantrum. Now, I might be wrong with the terminology here, but I do believe that it caused a taper tantrum. Once again, guys, let me know in the comments if I got that right or not. And you can see that the recession drumbeat is getting louder. And so the one thing that we have covered on this channel quite a bit is that layoffs are mounting and pessimism is taking hold. This is just a tough environment. It's a tough hiring environment. And you can see that CEOs are striking a mellow note in 2023. Now, I've already gone over on this channel. I won't bug you guys with it again. Just the number of layoffs that have happened, especially in the technology space. We did see sort of inklings that Alphabet may also do a large layoff. Meta announced a large layoff. Amazon announced a large layoff. And then many of the tech names that were high flyers in 2021 and in 2020 did also announce large layoffs. For example, like Shopify, Carvana, etc., etc. And so even in the crypto space, of course, there's large layoffs. And so, how does this play out in 2023? I think, companies are budgeting for that somewhat, and we'll see as announcements come out in 2023. But a glimmer of hope is the fact that inflation is in fact starting to decline. And so the rate increases are working. And so my question is, do we need as aggressive rate increases into the future? I don't think we do. And the market isn't really predicting as aggressive rate hikes into the future as well. And so I think that's the right move. But I do have to say that we have a long way to go. Inflation is still pretty high, especially relative to the recent historical rate. And so we still got to get it down to around that 2% area. And I think there could potentially be some pain on the horizon. And so once again, we're at 7.1% as of November of 2022. And we'll see how this sort of plays out. But of course, a lot of people are saying, and so one of the ways for the inflation rates to come down further is that we just have a little bit more unemployment. But we'll see, or just weaker wage growth with employment, not necessarily unemployment, but we'll see how that plays out. And so the question you guys might be asking is, because the stock market has come down so much, I think it's probably come down around 16 to 20%, call it somewhere around there. Is the stock market cheap now because it's come down so much? Well, I got some bad news for you. I tracked 2 publicly available indicators, and they're suggesting that the stock market is not necessarily cheap just yet, relative to historical averages at least. And so you can see here that, I'm looking at the Shiller PE ratio and I'm looking at the Buffett indicator. And unfortunately, both of these indicators say that the stock market is not cheap. You notice that the Shiller PE ratio is currently at 28 times earnings, and it has an average mean of 17 times earnings. Even if you were to say that, in the current economy, because this only tracks the last 10 years, it takes a current valuation divided by the average earnings over the last 10 years. You could say that in the current environment that the PE ratio should be a little bit higher, but even around 20 times I think would be the highest you'd probably want to get here. You're still suggesting that it's slightly overvalued. So we have some way to go. I remember when I put out a video early in 2021, I did say that, it was closing in on 40, and so of course it needed to come down. And it did a little bit. I'm not saying that I predicted it. I was just looking at the chart and just comparing it to historical averages. So no Nostradamus thing or anything from my perspective. No patting myself on the back there. Then the other one was the Buffett indicator, which we were looking at in early of 2021. We did say that it was 2 standard deviations above, and it has come down to 1 standard deviation above the historical trend line, but it's still trading at, 24% higher than the long-term average. So what these 2 indicators are suggesting is that the market has come down, but there's still more room for it to come down. So what does that mean to the question that I asked earlier? My opinion is, and I might be wrong here, is that in 2023, I believe that there's more room for the stock market to come down. Now, here's where I want to pause, and I really want you guys to opine in the comments below. Let me know what you think, and you can sort of subdivide your answer as well. You can say that, some industries are expected to come down, but some industries have really been beaten up, and they probably should be moving either sideways or slightly up. For example, one industry that I think will be moving sideways or slightly up in 2023 would be the housing industry, because it got beaten up so much in 2022. But you guys let me know what you think. Now, of course, on that last slide, I did say that I have one indicator that I track myself that is better than the 2 indicators that I previously mentioned, and that is the tracker that the Patreons have access to. And so, of course, this is a bottoms up indicator. It should show us names that are relatively cheap to their intrinsic value, because I try to stack this in that way. But of course, you can see that the tracker is telling the same story as the Shiller PE ratio and the Buffett indicator. Only 6% of the trackers, so you can see these 4 names, are trading at under 50% of their intrinsic value. And I unhighlighted one of them for you, which is Alibaba. They're trading at around $90 today. Their intrinsic value, I believe, is at around $225 per share. You guys tell me what you think the intrinsic value is. So there's, I'm not saying that this is the absolute value. This is just my opinion, but I could be wrong in many areas. And so I think that it's trading at approximately 39% of its intrinsic value. But once again, I want to know what you guys think. I've also uncovered Meta here, which is part of that second category, where I believe that 30% of the tracker is trading in between 50 and 75% of the intrinsic value. So not cheap, not expensive, or I would say not expensive at least. I like to buy things at around 50% of their intrinsic value or less. And so I have been looking at cash secured puts for Meta and Alphabet. But I know a lot of you guys are willing to buy them at these prices, and there's nothing wrong with that. Buying Alphabet at sub $100 per share is probably a good buy. Actually, I would say that it's a good buy. Buying Meta at anything close to $100 per share, I would think is a good buy as well. So I'm not, disagreeing with you guys if you guys have these positions at all. But you can see that they are part of this group where I believe that it's still a small part of the overall tracker. And of course, I'm not showing you most of it, but the biggest part of the tracker is the 64%, which is trading above that 75% of the share price divided by the intrinsic value, which you can see in this category above. It's sorted by that column, by the way. And so you can see I just unhighlighted one name, which is AMD. I'm valuing AMD at approximately $70 per share. It's trading at 63. So I'd like to see AMD drop a little bit further before I'd be interested in it. It is one of the chip makers, or at least chip designers, that I really like. But, you guys let me know what you think. But effectively what I'm saying is that the two market indicators are suggesting that the stock market has a little bit more to fall. And then my own personal tracker, which is what I use to gauge whether or not I'm going to enter into certain opportunities, is also saying that the stock market has a little bit more room to fall. And so this leads me into what my game plan is going into 2023. And largely, what it comes down to, my game plan will effectively be very similar to what it was in 2022. And recall, guys, now I don't make my portfolio performance public, so take what I say next with a grain of salt. I have outperformed the index by approximately 15% this year. Part of the reason why I was able to do that is I really focused on the downside. I sold a lot of cash secured puts that didn't end up in the money, or if they did end up in the money, the premium offset enough to still provide me with a gain. And so that's where a lot of the gains came from in 2022 for my portfolio. Also, there were some securities that just ran up a lot further than I thought they would. And these were names that were sort of like out of the left field. You wouldn't even think about them, like a Crocs or something. But let's go into the game plan. So there's 5 items that I want to focus on. The first one is, of course, continue to focus on the downside risk. And so here's where I believe margin of safety matters. Now, a lot of people would comment on my videos, at least early on in the year, not so much later on in the year, where I was focusing on margin of safety. And so some of you guys were saying, you shouldn't really be waiting until these exceptional companies come down to 50% of their intrinsic value before you buy their shares. And I agree with you guys. I'm just very margin of safety focused. Some names I may buy a little bit higher, but I really like to buy around that 50% range. But, I miss out on a lot of opportunities because I'm stuck sucking my thumb while stocks run up. A great example in 2022 of a company that I really knew made a lot of sense and I probably should have been investing in, but I missed out on, was H&R Block. And I will continue to note that as a risk. I think it ran, or a failure of mine, I think it ran like 50 or 60% in 2022. And so that was one that I really missed. Now, I'm going to continue utilizing cash secured puts. Now, these are not for everyone. Cash secured puts are largely for people with larger portfolios. But what they allow you to do is they allow you to set a purchase price for where you would like to buy that stock. And if it doesn't come down to that purchase price area, then, you still generate a return. But the thing that I do want to point out with cash secured puts is that the stock price could actually run much lower than even the price that you're willing to pay, less the premium that you generated from it. So say you wanted to buy Alphabet at $75 and you sold a cash secured put for $20 on that. I don't know what the price is. And so you have a net purchase price of $55. Well, the stock price could have gone down to $45. So you would still be in a net loss position. Now, does that matter? Not really, because you ended up purchasing for the price that you wanted to buy at. But I just wanted to point out the risk inherent with cash secured puts. It's not for everyone. It's generally for larger portfolios because you have to trade in a stack of 100 shares. And so, a stock that's trading for $100 per share, like Alphabet, the minimum you'd have to put up is $10,000. And so it's not for everyone. And so what is for everyone is margin of safety. So I'm going to continue focusing on margin of safety when it comes to positions that I enter into. The second thing that I'm going to focus on is I'm going to continue to seek out special situations. So one special situation, this kind of goes in line with margin of safety, is just the valuations in China, I think, have been decoupled from the risks of the companies themselves. And I think it's moved more to sort of like FUD as it relates to investing in China as a whole. And so I did purchase Alibaba a couple of years ago. I doubled down in 2022, and I'm going to continue focusing on valuations in China. Now, I have a full valuation for Tencent coming out soon. The Patreons can get access to the Tencent model. That's available right now. The other special situation that I did see in 2022, which I do believe that we will ultimately make money on, is the Activision deal. Now, this isn't a a recommendation for you to buy into the Activision deal. I'm just saying that this is something that I've invested in, and I do believe that it will work itself out. And then the third one is the Albertsons deal, and I'll cover that in a video on this channel very soon. It's a grocery company or a grocery store company being purchased by Kroger, but it's not for sure that this deal will happen, and so there's risks in this deal, and I'll try to outline all of it. But once again, this is never a recommendation for you to buy into it or not. The third item that I want you to focus on, or at least I'm going to focus on, is seeking out secular growth trends. And so the big item here is that I'm not going to pay attention to the short-term pain. So for example, and I'll just jump to the bottom one here, housing in America. America is underbuilt, and I've talked about that in many videos. People don't really care about investing in the housing market, and that's why I do believe that it's going to generate large returns for me. And so I don't care about short-term or even medium-term pain. I think over the long term, these home builders, especially the well-capitalized home builders that are in areas where people are migrating to, in other words, there's a lot of pent-up demand for homes, and you will see more housing be built as the rates come down once we get sort of inflation taken care of. I think these stocks will run before any sort of inclination that rates are even going to start to decline. And you saw these stocks already start to run in 2022 in the latter half. And then the other area is valuations in China. I think eventually these valuations will reset, but there is some short-term to medium-term pain. There's a lot of risks of investing in China, but overall, I think we're winners here in this space. The fourth item that I'm going to be keeping track of in 2023 is keeping track of fallen angels. So for example, when I originally was looking at Microsoft, it was trading at above 100% of its intrinsic value, somewhere around 120%. Now it's trading at 70% of its intrinsic value, and the company continues to fire on all cylinders. So this is a name that I know a lot of you guys do get angry that I haven't purchased it just yet, but I'm patient. And you know what? If this comes down to where I want to buy it, or the cash secured puts become lucrative to the point that I can pick this up at a net purchase price of 50% of its intrinsic value, I'll be very happy with it. And so I'm waiting for this to come down, and I think as the market continues to come down in 2023, which I do believe it has a potential to, I think this potential falling angel becomes a name that I add into my portfolio. So I'm very closely watching this, and this is where the tracker is key, because every day I log into the tracker and I just take a look at where my favorite names are trading at and whether they're getting close to where I'd like to purchase them. And things can happen to other names that I'd really like to add into the portfolio. For example, these are all names that are trading at over 100% of their intrinsic value, but could there be short-term pain on the horizon for Progressive Insurance, Nike, Starbucks, or Costco? I don't know, but because they're on the tracker, I'm following the story, and we'll see if these shares come down in the medium to short term. Who knows? Something could happen in 2023 where all of these names come down considerably. We could have a March of 2022 type of environment. And so you absolutely can bet that I'll be deploying capital into these names. These are the types of names that I would like to buy at, that, or at least I would say Progressive, Nike, and Costco, maybe not necessarily Starbucks, are names that I would like to buy, and I would buy them at 60, the in between 50 to 60% of their intrinsic value. I don't have to get them all the way down to 50. Microsoft is also that kind of name where if I can get Microsoft at 60% of its intrinsic value, I'd be happy with that one as well. And so we'll see if these come down. And so keeping track of falling angels is very important and a very key part of the strategy. And I was able to pick up one name that I believe it was a falling angel in 2022 that actually provided a considerable amount of benefit to the portfolio in 2022, which was, of course, Zillow Group. And so that's a name that a lot of people didn't like, but I actually ended up making quite a bit of money on that name. And so the final point that I want to make, and this is something that a lot of people were bashing when inflation was rising, is that, hey, you shouldn't be holding cash. And so as soon as people were saying that, in my opinion, cash became king. And so I was the only one on YouTube talking about being more than 50% in cash in 2021. And in fact, you guys know the story that I actually started selling off into the strength of 2021, and then I needed something to do because I had nothing to do after work because the security markets didn't provide me with a lot of opportunities as it related to doing more and more research. And so I kept doing my regular amount of research, but I had extra time. And so I bought a smoker. I started learning how to smoke meats, and I started learning how to bake. I started making cake pops, which was really funny. But the point I'm making is that market crashes are virtually always a result of liquidity. They're not a result of just people believing now the intrinsic value of these securities is lower. It's a liquidity crunch. It always is. And so when you have cash, you are king. And so just like in March of 2020, when I had a lot of cash and I deployed everything into the market, I was 100% invested in March of 2020. I will be ready if something like that were to happen again. And if it doesn't happen, no problem, because I'm being very selective, very greedy with the types of opportunities that I'm investing in. Now, I recognize that I'm in almost what I would consider an excessive amount of cash, but hey, I'm looking for these opportunities, and I don't have the cash burning a hole in my pocket. I will find the opportunities as they come, and if I don't, that's not a problem for me. It doesn't matter at the end of the day as far as I'm concerned. I'm not looking to beat the market. I'm looking to make good investments. I just so happen to beat the market in 2022, but when the market is running up, I will not beat it. I will probably do much worse than the market as it's running up. But the way that my portfolio is structured is that I focus on rule number one, which is don't lose the money. And if you guys can't remember rule number one, just at least remember rule number two, which is don't forget rule number one. Now, I want to know how you guys are trading in 2023. What's your game plan? Let me know in the comments below, because I want to highlight what you guys say in a subsequent video. And so I'll leave it there. But the one thing that I do want to point out to you guys is that I'm a little bit of a bear on Intel Group. And I know a lot of the value investing community likes Intel. And so I actually did a full valuation on Intel, which you can get to right here. And I want you guys to let me know whether you agree or you disagree with my valuation and thesis. There is no right or no wrong answer. So I want to hear what you guys have to say, because I'm going to be making a video on what you guys think about Intel's valuation in a future video. And so I'll leave it there for you guys, and I'll see you later.